Recently, I've learned that the stock market just doesn't go up or down on its own, and in this video, I'm going to share with you when is the right time to be buying stock. However, the answer isn't so straightforward. What is up everybody, Gifford here and welcome back to another video. And before I start this one, I just want to go off with a quote because it's pretty damn important. The stock market is a device for transferring money from the impatient to the patient. And this is by Warren Buffett. So this video is about stock market cycles. The stock market is made up of businesses and companies. Therefore, it's pretty obvious that the stock market is related to business cycles. And getting straight into it, business cycles are therefore impacted by monetary policies set out by different governments. And the most well-known one is the Fed, which is the Federal Reserve for the United States. And for people here in New Zealand, we have our own, which is called the Reserve Bank of New Zealand. So this leads us to the main question, when is the best time to buy stocks? So this graph here is a typical business cycle. We can see that it has stages 1 to 6 and it has contractions and expansions. So bottom to top. And by the way, this is just a simplification of the cycle itself. It's actually pretty difficult to see it in real time, but in hindsight, it seems pretty obvious when you look at the charts. The one thing to get is that business cycles is not related to the stock price. This is how you find opportunity in the market. You buy at the bottom and then sell when you think it's overvalued with set metrics. So having a look at the business cycles, we can see here that stocks and commodities will go down as bonds will go up in this stage, and this is starting on its contraction phase. At stage 2 at the very bottom, this is when stocks and bonds start to go up and then commodities start to come down. So after the very bottom, when everyone has given up, this is when we go to stage 3 and commodities and stocks start to go up. We then hit over the zero line and then we can start getting to sort of the peak part. In stage 4, we see a rising of stocks and commodities, and then we see the bonds start going down. And at the very top, or the peak, stage 5, bonds and stocks will again start coming down, and then the commodities will start to go back up. And as it starts to go back to zero again, we can see that the bonds, stocks and commodities all go down. So at the moment, with my guess, my amateur guess in all this, is that we are starting in this phase here. So this then leads us to the investing cycle, and we have another graph here, and again this is just a simplification of how things work. This doesn't really work 100% when you just look at a graph, otherwise everyone would know what to do and everyone would be making money. It's not that simple. But we can see here that the stock market is forward looking, therefore the stock market will react much quicker than what is actually happening right at the current business cycle. We can see here that the investing cycle, it's pretty much one step ahead or a couple of stages ahead of what the actual business cycle is doing. So just an example, if the war was to stop, on the news alone would actually send the markets up. Another indicator that the market could possibly go up is that the reports of inflation is going back down again. And at the very bottom here is a bit of a mistake, so interest rates would actually start to go back down and the money would flow back into stocks. So not back up, it would actually be back down. And in my opinion, just what's happened to stocks in the last 11 months or year to date this year, we are generally in a bear market. So we're just waiting for it to topple off, and it's really waiting for what's happening in the world and also inflation to come back down. And inflation currently in New Zealand is about 7.2%. So here's just a graph of the bull and bear market that's happened previously. Now, I only really care about the last 50 years because before that, technology and the way the markets were is very different. Now we have technology and a lot of things can happen very quickly. So these cycles can actually last a decade. Some of it is just quicker than others. Investing in the market is also a long-term game. And during a bear market, holding a company that doesn't make any money is going to be high risk. So the high risk I'm talking about is if they are negative PE, no earnings, negative leverage cash flow, and also declining growth and also declining market share. So you want to be picking companies that can survive the bear markets, because when the money starts floating in and interest rates are low enough, the company is going to be having access to that money to put back into their business to then grow their business. But they have to survive the bear market when interests are really high, the costs to do business is really high, and they could actually go bankrupt. But the really good thing for investors is that bull markets are longer than bear markets. So if we can just sustain this part here, although in bear markets it's really difficult because they can really shoot down quite a lot. So that's negative 50%, negative 44%, and in the S&P 500 it's about negative 20, and I know that in the NASDAQ it's minus 30%. So while we are on our way to these numbers here, we don't know how far it could go down, or it can actually start reverting back up again. So just to summarize, cycles in business are real. However, no one can predict what the market will actually do, including myself. This is only a guide. Some common rules that I follow by is that I only invest money that I can afford. I invest for the long term, so at least over 2 to 3 years is what I consider long term. I don't want to say I invest for 5 to 10 years because I haven't been investing in the stock market for that long, so it's kind of foolish of me to say I invest for 10 years because I haven't been doing that. So to me, long term at the moment is 2 to 3 years, and also profitable growing companies will always recover and survive in the bear market is what my research has told me. So what am I doing? Well, I'm saving money now to slowly invest. As you know, if you watch some of my portfolio videos, I've spent a lot of money on Tesla quite early at the $260 mark. I should have waited because the price is now $180. I've still been buying now, dollar cost averaging into it while I can. So I'm still following my strategy, although I did pull the trigger a little too early on that one. And also, if I'd learnt this beforehand, that I did pull the trigger, so if I knew I got this information, I probably would have waited a little bit because it's so obvious that we are going into, already are into a recession. Inflation is very high. The typical is 7.2, and typical target for New Zealand is 1 to 2%. So you know there's going to be a lot of pain coming up. All the commodities, all the stuff that the CPI, the consumer goods that we're going to have is going to be more expensive. Now getting into the time to be buying stocks and not beforehand. Anyway, that's it for this video. Thank you very much for watching. Please hit like if you like this kind of content, and subscribe if you're interested in investing. Also, I post on Instagram, so feel free to follow me there while I'm not on here. The trading platform I use is Interactive Brokers, Hatch Invest, Stake, and Sharesies for individual companies, and I use Investnow for index funds. If you want to start investing, you can use any of my referral codes down below to start your own investing journey if you are from New Zealand. Thank you very much. I'm not a financial advisor, and make sure you do your own due diligence in the stocks that you buy, and I'll see you in the next one. Goodbye.